There are moments when a policy change looks like politics on the surface, but underneath it is really capital allocation. That is how I look at the energy and power grid story. Most people are watching the obvious parts of the artificial intelligence. Boom, they are watching NVIDIA, they are watching chips, they are watching software, they are watching large language models. They are watching the companies that sit directly in front of the public's attention. But the machine underneath the machine is power. AI does not run on excitement, it runs on electricity. Every data center, every GPU cluster, every model training run, every inference workload, every cloud expansion, every server rack, and every cooling system depends on a physical grid that was not built for this level of demand. That is the part many investors are missing. The AI boom is not only a semiconductor story, it is an energy infrastructure story. And when a technology boom collides with an old physical infrastructure system, the opportunity does not stay inside the most obvious companies. It spreads into power generation, transmission lines, substations, transformers, switchgear, cooling components, uranium, aluminum, copper, engineering, construction, and long-term government-backed contracts. That is where the money begins to flow. When I look at this situation, I do not begin with a stock tip. I begin with a principle. Follow the money, not the headlines, not the speeches, not the social media excitement, not the story that is easiest to understand. Money flows reveal what the institutions are doing before the mainstream narrative becomes obvious. Large investors do not wait for the public to understand a trend. They look at orders, contracts, backlogs, spending commitments, supply shortages, government programs, and price action in obscure parts of the market. That is how serious investors think. They ask where the capital is going now, not where people might talk about it later. The power grid is one of those situations. America has a massive infrastructure problem. Data centers are demanding power at a pace. The grid was never designed to handle AI workloads run constantly. They do not sleep at night. They do not reduce demand because the weather is inconvenient. They do not wait politely while utilities spend 5 to 10 years approving new grid connections. This is the structural problem. Demand is moving at software speed. Supply is moving at infrastructure speed. That gap creates pressure, and pressure creates spending. The grid was built for a very different era. It was built around homes, factories, refrigerators, air conditioners, offices, and a much simpler electricity demand profile. Today, it is being asked to support AI, supercomputing, data centers, electric vehicles, semiconductor manufacturing, electrified industry, and always on digital systems at the same time. Much of the grid is old. Transformers are aging, substations are strained, transmission capacity is limited, permitting is slow, utilities are cautious, equipment supply chains are tight, the build-out takes years. The AI cycle is moving much faster than that. That is why private companies are beginning to behave like utilities. If a data center cannot wait for a grid connection, it must find power another way. It can build or contract for its own generation. It can use fuel cells, it can explore nuclear, it can use natural gas generation, it can sign power purchase agreements, it can create an energy system next to the compute system. This is a major shift. Large technology companies are no longer simply buying electricity from the grid and accepting the existing system. They are increasingly shaping the power system around themselves. That tells you something important. The bottleneck is no longer only chips. The bottleneck is electricity. When a bottleneck becomes clear, the money flows toward whoever can relieve it. That is the investor's job. Find the bottleneck. Find who is paid to remove it. Find whether the payment is theoretical or already contracted. Find whether the company has the ability to execute. Find whether the market has already priced it in fully or only partially. That is the discipline. Now, the policy change matters because it gives the grid build-out official backing, an executive order focused on grid reliability and security signals that the government recognizes the problem. More importantly, policy can accelerate spending, extend the life of power plants, fast-track critical agreements, and push money into the sectors that can increase capacity. Policy does not create the entire trend. The AI power demand already exists. The aging grid already exists. The private sector need already exists. But policy can act as an accelerant. It can turn a slow trend into a funded trend. It can give companies longer revenue visibility. It can make contracts more durable. It can reduce uncertainty around which projects move forward. It can direct institutional attention towards sectors that were previously treated as boring. And boring sectors can become very profitable when they become unavoidable. This is one of the most important lessons in markets. The greatest opportunities are not always in the most glamorous company. Sometimes they are in the companies that do the necessary work behind the glamorous companies. AI gets the attention, but power gets the contract. The stock market often rewards the visible story first, then eventually realizes the invisible support system has pricing power too. That is what appears to be happening here. While the broad market may move only a few percentage points over a period, certain power infrastructure, engineering, construction, electrical component, and energy names can move far more because capital is rotating into the specific parts of the economy that benefit from the build-out. This is what following the money looks like. If the S&P 500 is flat or modestly higher, while powerline construction companies, engineering contractors, electronic component makers, fuel cell companies, switchgear producers, and cooling system companies rise sharply. That is not random, it is information. Price action is not always truth, but it is always evidence. When price action aligns with real spending, backlogs, contracts, and policy support, the signal becomes stronger. That is the difference between hype and capital flow. Hype is talk, capital flow is money moving. Now, the most important metric in this kind of situation is backlog. A backlog is not a dream, it is work already sold, it represents signed contracts and future revenue visibility. It is not the same as a projection, it is not a press release about a possible market opportunity. It is not a vague statement that demand may grow. It is work waiting to be executed. That matters because infrastructure companies do not move only on narratives. They move on orders, contracts, and execution capacity. If a company has a large and growing backlog, it tells you customers are not merely talking, they are committing capital. It tells you the revenue pipeline is becoming more visible. It tells you the trend is moving from idea to implementation. That is why backlog is one of the key signals. For example, a company like Quanta Services has been described as having a very large backlog, tens of billions of dollars of work tied to grid infrastructure. That is not a small number. It represents years of potential revenue visibility. When a company builds transmission lines, substations, and the physical infrastructure required for grid expansion, and the backlog grows, you can see the demand becoming real. That is a different kind of evidence from a CEO saying the future looks exciting. Contracts matter, backlogs matter, utilities and government-related spending matter. The more boring the work, the more important the backlog can be. Now, let us break the opportunity down into sectors. The first major sector is off-grid power generation. This is one of the most important parts of the story because it shows how severe the bottleneck has become. If a data center cannot wait years for a grid connection, the company may choose to generate power on site or contract for dedicated power. That means private companies start building or buying electricity outside the traditional utility pathway. This benefits companies that can provide power close to the demand. Fuel cells are one example. Bloom Energy is a company that produces fuel cell systems that can sit near a data center and generate electricity on site, often using natural gas. The idea is simple. Instead of waiting for new transmission lines and grid upgrades, a data center can use distributed power generation to meet its needs faster. This does not eliminate all risks. Fuel costs matter, margins matter, execution matters, the durability of contracts matters, competition matters, valuation matters, but the strategic problem is real. Data centers need reliable power quickly, and on-site generation can be part of the answer. That is why a company like Bloom can attract attention after signing major power-related deals with large technology or data center customers. When a real customer commits to a large amount of power, the market begins to take the company more seriously. The second off-grid path is nuclear, especially small modular reactors. Nuclear has gone through a remarkable change in perception. For years, many investors and policymakers treated it as politically difficult, expensive, slow, and controversial. But AI power demand is forcing a new discussion. Data centers need constant baseload power. Solar and wind are useful but intermittent. Batteries help, but they do not fully solve the problem at the scale and reliability required. Natural gas can provide baseload, but it carries emissions concerns. Nuclear offers dense carbon-free baseload power. That is why companies like Oklo and other small modular reactor names have attracted attention. The idea is that smaller nuclear systems could eventually provide reliable power for industrial sites, data centers, and other high-demand users. Again, the risk is substantial. Nuclear projects involve regulation, safety, construction timelines, financing, public acceptance, fuel supply, and execution complexity. Small modular reactors are not a simple overnight solution. Many companies in this space are still speculative relative to mature infrastructure businesses, but the direction of interest is clear. Microsoft, Amazon, Google, Meta, and other large technology companies have all explored or engaged with nuclear-related power strategies. In various ways, that tells you the demand problem is large enough that previously unpopular solutions are becoming investable. Again, if nuclear demand rises, uranium becomes part of the chain. A reactor needs fuel. If the world underinvested in uranium mining during the years when nuclear was out of favor, then renewed demand can create supply tightness. That is why large uranium suppliers such as Camco become part of the broader power and AI infrastructure discussion. This is the picks and shovels logic. If you are uncertain which nuclear developer wins, you can look at what all nuclear projects require: fuel, materials, engineering, permits, components. The second major sector is physical grid builders. These are the companies that build the actual infrastructure: transmission lines, substations, pipelines, power plants, electrical systems, mechanical systems, data center cooling. These businesses may not sound as exciting as AI software, but if the grid must be rebuilt, expanded, hardened, and modernized, they become essential. Quanta Services is one of the largest names in grid infrastructure construction. It builds transmission lines and substations. It does the physical work that allows electricity to move. If America is going to expand the grid, companies like this are likely to be involved. Mastech is another name tied to infrastructure construction, including power lines and pipelines. If more natural gas generation is required to support data centers and power plants, pipeline and energy infrastructure contractors can benefit. Argon focuses on power plant construction. If the system needs new generation capacity and must keep certain plants operating longer, companies that design and build power generation assets can be positioned to receive contracts. Comfort Systems works in mechanical and electrical contracting, including the kinds of cooling and electrical systems required by data centers. AI data centers have enormous cooling needs. The chips produce heat, the buildings require complex thermal and power management. The physical systems are not optional. This is the part investors often miss. The data center is not just a building with computers, it is an industrial machine. It needs power distribution, cooling, electrical contracting, backup systems, control systems, and constant reliability. Every new data center creates demand for a web of suppliers and contractors. The third sector is the electrical component layer. If grid builders are the picks and shovels of AI infrastructure, then component makers are the picks and shovels of the grid builders, power modules, switchgear circuit boards, cooling systems, transformers, electrical distribution equipment, advanced power conversion. These are specialized products with high barriers to entry. Not every company can suddenly make them at scale in a surge of demand. Specialized suppliers can become bottlenecks, and bottlenecks can create pricing power. Viker, for example, is tied to power modules and power conversion. Advanced chips require quality power conversion. If AI processors, data centers, and grid equipment need more sophisticated power management, companies in this layer can benefit. Powell Industries makes switchgear and electrical distribution equipment. These systems control where electricity flows and protect against overloads in a world building more substations. Data centers and industrial power systems, switchgear demand can rise. Vertiv is tied to thermal management, cooling, and power infrastructure for data centers. AI chips generate enormous heat. Traditional cooling may not be enough. Liquid cooling, advanced thermal systems, and reliable power infrastructure become central. TTM technologies and advanced energy industries also sit in related electronics, components, power, and high reliability systems that can be pulled into the grid data center and electrical infrastructure cycle. The key principle is that components often become the hidden constraint. The public focuses on the big project. The project depends on a specific part. The part has limited supply. The supplier's order book improves. Margins may improve. The stock moves before the public understands why. That is why looking one or two layers down the supply chain can be so powerful. The fourth sector is raw materials. You cannot build a grid without materials. Transmission lines require aluminum and copper. Transformers require copper and steel. Data centers require enormous amounts of electrical equipment. Nuclear requires uranium. Power infrastructure requires physical inputs that cannot be created with a software update. If the policy direction favors domestic infrastructure, tariffs, domestic sourcing, and large-scale rebuilds, then certain domestic materials producers can benefit. Aluminum names such as Century Aluminum or Alcoa become relevant, copper producers become relevant, uranium suppliers become relevant. This is another version of the same principle. When a major trend is real, do not only look at the final product, look at the inputs. AI requires data centers. Data centers require power. Power requires grid upgrades. Grid upgrades require contractors. Contractors require components. Components require materials. Materials require miners, smelters, refiners, manufacturers, and logistics. That is the chain. The investor who sees the chain can find opportunities before the headline investor does. Now, there is a fifth important category, which is the policy and contract layer. Government involvement changes the character of revenue. A normal commercial contract can be strong, but a long-term government-backed or utility-backed contract can provide unusual visibility. Power purchase agreements can last 10, 15, or 20 years. Military and critical facility contracts can be sticky. Utility infrastructure spending can be regulated and planned over long periods. That is why investors care about the quality of the customer and the duration of the contract. A company with volatile one-time sales is different from a company with long-term contracted revenue. A company selling into a speculative customer base is different from a company selling into government, utility, military, or hyperscale data center spending. The source of demand matters, the durability of demand matters, the ability to execute matters. Now, it is important not to get carried away. A strong macro trend does not make every stock a good buy at every price. Some of these names have already moved sharply. A stock up 100%, 150%, or 200% may still go higher. But the risk profile has changed. When a stock has already moved significantly, you need to be more careful about entry, valuation, expectations, and position sizing. This is where many retail investors make mistakes. They discover the theme late, then buy the stock that has already moved the most because it looks like the winner. Sometimes that works often. It means they are buying after institutional money has already positioned. The public sees the obvious winner after the easy money has been made. But being a little late is not always bad. This is subtle. Being too early can be painful. A theme can be right but take years to move. Capital can sit idle. Companies can burn cash. The market can ignore the story. Being slightly late after contracts. Backlogs and price action confirm the trend can sometimes reduce risk because the thesis is less theoretical. The key is not early versus late. The key is whether evidence and price still create a favorable risk reward. Wall Street often prefers evidence over imagination. It does not always need to be first. It wants enough confirmation that the probability of being right has improved. That is why backlogs, contracts, and sector rotation are so important. They tell you whether the trend is becoming real. Now, the framework for finding these opportunities can be broken into 3 steps. First, zoom out and identify an undeniable trend. Not something that might happen, not something based only on a story. Something already happening at a scale too large to ignore. In this case, AI needs electricity. Data centers are being built, the grid is old, grid connection timelines are long. The government has recognized the reliability issue, utilities and private companies are spending money. That is not a fantasy, that is observable. The trend must be large, durable, and tied to real capital spending. Second, ask who benefits directly, not who sounds exciting, who gets paid. If AI needs power, who sells power systems? If the grid needs upgrades, who builds transmission lines? If data centers need cooling, who provides thermal systems? If nuclear returns, who supplies uranium? If power plants are built, who constructs them? If electrical systems expand, who makes switchgear and power modules? The answer is often not the company in the headline. The answer is the company with the invoice. That is where follow the money becomes practical. Third, look for evidence that money is already flowing. Backlog, contract wins, revenue acceleration, capital expenditure commitments, government programs, utility plans, customer concentration with high-quality buyers, margin expansion, relative strength in the stock sector, level performance versus the broad market. These are the signals that separate a real trade from a story. A stock idea based only on narrative is fragile. A stock idea supported by contracts, backlog, and money flow is stronger. Not safe, stronger. There is always risk. Policy can change. Valuations can become excessive, execution can fail. Supply chains can bottleneck, interest rates can pressure infrastructure spending, a company can disappoint, a contract can be delayed. The market can rotate away, a recession can hurt demand. A good investor does not deny risk. A good investor sizes risk. That means no single infrastructure stock should become an uncontrolled bet. If the theme is strong, build exposure thoughtfully, use baskets, use position limits, watch valuation, understand the balance sheet, study the backlog review, customer concentration. Know whether the company is profitable or speculative. Know what would make you exit. This is the difference between investing in a trend and being seduced by a trend. A trend gives direction. Risk management determines whether you survive the path. Now let us connect this to system thinking. The world operates through cause and effect relationships. AI demand rises, electricity demand rises, grid constraints appear. Data center developers face delays. They seek off-grid or dedicated power. Power generation companies receive demand. Grid builders receive contracts. Component suppliers receive orders. Raw materials demand increases. Government policy accelerates spending. Investors notice backlogs and relative strength. Capital flows into the winners. Valuations rise. More public attention appears. Late buyers chase. Volatility increases. That is the causal chain. If you understand the chain early enough, you can position before the final stage. If you wait until everyone is talking about it, you may still find opportunities, but you must be more selective. This is why the news itself is often late. By the time an executive order becomes mainstream, some stocks may have already moved for months. That does not mean the trade is over. It means the market was discounting the policy and spending before ordinary investors understood the full story. Markets are forward-looking. They do not wait for certainty. They move when probabilities change. So the key is to watch the data before the narrative becomes obvious. The data is often public. Backlogs are public. Stock prices are public. Government programs are public. Company filings are public. Capital expenditure plans are public. Utility spending plans are public. The problem is not that the information is hidden. The problem is that most people are watching the wrong screens. They watch broad headlines, institutions watch money flows, orders, contracts, and relative strength. That is a different game. Now, the executive order itself should be understood as part of a larger policy shift. Grid reliability and security are no longer niche technical issues. They are national economic issues if AI becomes central to competitiveness, military capability, productivity, and corporate investment. Then power supply becomes strategic infrastructure. A country that cannot power its data centers cannot lead in AI. That is the deeper point. Power is no longer merely a utility concern. It is a national competitiveness concern that changes how governments act. They can use emergency authority to keep power plants running. They can speed up agreements for military and critical facilities. They can support transmission projects. They can push utilities and private capital toward capacity. They can justify keeping older baseload power online if reliability is threatened. This can benefit coal and gas plants in the short and medium term, even if long-term energy transition goals remain. Why? Because data centers need power all the time. Solar does not generate at night. Wind does not generate when conditions are wrong. Batteries help but have limits. Baseload capacity matters. That is not an ideological statement. It is an engineering statement. AI workloads require reliability. Reliability requires firm power. Firm power often requires nuclear, gas, coal, hydro, geothermal, or storage. Backed systems, the more realistic the system becomes, the more it must confront physics. Markets sometimes trade dreams. Power systems run on physics. That is why the energy trade can be more durable than people expect. The demand is physical, the constraint is physical, the solutions require physical capital. Physical capital takes time to build when supply cannot respond quickly. Companies positioned in the bottleneck can benefit now. Let us consider the possibility that some of the move has already happened. Many stocks tied to this theme have already appreciated sharply. That creates a dilemma. Do you chase? Do you wait? Do you ignore it? The right answer is not universal. If a stock has moved sharply but the backlog is accelerating, contracts are improving, margins are expanding, and the total addressable spend is increasing, it may still have room. If a stock has moved sharply only because of hype without fundamental confirmation, the risk is much higher. Again, evidence matters. You can also look for second-order names that have not moved as much. Sometimes the first wave moves the obvious leaders. The second wave moves suppliers, materials, smaller contractors, or companies with delayed recognition. A raw material producer that has not re-rated may become interesting if the demand chain remains intact. A component supplier with improving orders may move after the headline names. This is why a theme should be mapped, not memorized. If you only memorize a list of tickers, you are dependent on someone else's work. If you understand the system, you can find new names, compare them, and update as facts change. That is the real skill. A list expires. A framework compounds. The framework here is simple. Start with a macro force. AI is increasing electricity demand. Then identify the constraint. The grid is old and slow to expand. Then identify the policy response. Government support and emergency authority accelerate reliability and capacity spending. Then identify the direct beneficiaries: power generation, nuclear, fuel cells, grid builders, transmission contractors, power plant contractors, data center mechanical and electrical contractors. Then identify the component beneficiaries: switchgear, power modules, circuit boards, transformers, cooling, power conversion. Then identify the raw material beneficiaries: aluminum, copper, uranium, and other inputs required for infrastructure. Then identify confirmation backlogs, contracts, relative strength, revenue growth, margins, guidance, capex plans. Then manage risk valuation, position size, diversification, exit criteria. This is how you think like a system. Now let us talk about what most people will do. They will wait until the story becomes obvious. They will see a headline about AI power demand. They will see a stock that has already doubled. They will feel that they missed it. Then they may either chase emotionally or avoid the entire theme because they think it is too late. Both reactions can be wrong. The mature response is to break the theme into layers and ask where the risk-reward still exists. Maybe the obvious leader is expensive. Maybe a supplier has not moved enough. Maybe a raw material play is just beginning. Maybe a construction company has a backlog that justifies a higher multiple. Maybe a speculative nuclear name has too much hype and not enough revenue. Maybe a profitable infrastructure company offers lower upside but better risk-adjusted exposure. Maybe the right answer is a basket. Maybe the right answer is to wait for a pullback. The point is to think, not react. This is especially important because the grid and energy trade can be volatile. Policy headlines can move stocks, interest rates can affect infrastructure valuations, commodity prices can swing, nuclear names can move on sentiment, data center demand can be revised, permits can delay projects, earnings can disappoint. A real trend does not eliminate volatility. It often creates more volatility because expectations become high. That is why position sizing matters. If you own a basket of infrastructure beneficiaries, one mistake does not destroy you. If you put everything into one speculative name because it sounds exciting, you may be right about the trend and still wrong about the investment. This is a common error. People confuse theme risk with company risk. The theme can be right and the company can fail. The theme can be right and the stock can be too expensive. The theme can be right and the timing can hurt you. The theme can be right and dilution can damage shareholders. The theme can be right and execution can miss. So always separate the trend from the vehicle. Now, what makes this trend particularly interesting is that it is tied to both private and public spending. Private technology companies are racing to build AI infrastructure. They have large balance sheets, they need power, they can sign long-term contracts, they can fund dedicated solutions. Government policy is pushing grid reliability and security. Military and critical facilities need assured power. Public money and authority can support build-out. Utilities have regulated spending plans. When private capex and government policy align, the spending can become powerful. That does not mean every dollar is efficient. Government spending can be wasteful, projects can be delayed, costs can overrun, political priorities can change, but when the need is real and the money is large, companies that execute can benefit. This is why backlogs are important again. They show which companies are actually receiving the work. Now, let us go deeper into the off-grid trend. A data center waiting 5 to 10 years for a grid connection is not an acceptable business plan if AI demand is moving. Now, hyperscalers and large enterprises cannot simply pause while utilities catch up. That is why they explore fuel cells, gas turbines, dedicated power plants, nuclear agreements, battery systems, and hybrid energy solutions. This creates a new type of customer for energy companies, a technology company with urgent demand, large capital resources, and a willingness to sign long contracts that is attractive. But it also changes competition. Energy providers that can deliver quickly, reliably, and at scale have an advantage. Companies that cannot execute may be left behind. The market may reward speed and credibility more than distant promise. Fuel cells can move faster than nuclear. Gas generation can move faster than large transmission projects. Small modular nuclear may be strategically attractive but slower and more regulated. Each solution has a different time horizon that matters for investors. Shorter cycle solutions may see revenue sooner. Longer cycle solutions may offer bigger strategic upside but more uncertainty. A balanced approach may include both. Now, the physical grid builders are more immediate in many ways. Transmission lines, substations, and utility upgrades are already required. If backlogs are large, the work is already in motion. These companies may not have the same explosive narrative as speculative nuclear names, but they can have clearer revenue visibility. A company with a $44 billion backlog has a different risk profile from a company waiting for regulatory approval of a future reactor design. Both may benefit from the same macro trend. They are not the same investment. The component companies sit somewhere between. They may have strong demand visibility if orders are flowing, but they can be more sensitive to cycles, margins, supply chain constraints, and customer concentration. Some may have high valuations after large moves. Some may still be under-recognized. Raw materials are another distinct category. Copper, aluminum, and uranium respond to global supply and demand, inventories, mining capacity, tariffs, geopolitical risk, and commodity cycles. A grid build-out can support demand, but commodity prices can be volatile and influenced by many factors beyond AI. This is why mapping the layers matters. Each layer has its own risk: generation risk, construction risk, component risk, commodity risk, policy risk, valuation risk, execution risk. A good portfolio does not pretend these are identical. It sizes them according to confidence, volatility, and time horizon. Now let us talk about tariffs and domestic sourcing. If the government wants to rebuild American infrastructure with domestic labor and domestic materials, then domestic producers can receive a tailwind. Tariffs on foreign metals can change relative economics. Domestic aluminum producers, for example, may benefit if imported materials become more expensive or if government projects favor domestic sourcing. But tariffs also create complexity. They can raise costs for downstream companies, they can trigger retaliation, they can distort markets, they can benefit one sector while hurting another. Investors must avoid simplistic thinking. A tariff can be positive for a domestic producer and negative for a company that needs cheap imported inputs. The same policy can create winners and losers inside the same broad theme. Again, follow the mechanics, do not just follow the slogan. Now, this whole theme also shows why sitting only in the broad index can feel frustrating during certain market periods. The S&P 500 may move only modestly while specific sectors inside the market move dramatically. If you do not study sector rotation, you may think nothing is happening, but money is moving under the surface. This does not mean everyone should become a short-term trader. It means you should understand that markets are not one thing. Capital rotates, themes emerge, institutional flows concentrate in areas where earnings, contracts, and policy support are improving. If you can identify those rotations intelligently, you can sometimes find better opportunities than the broad index offers in the short to medium term. But this requires discipline. You must know when the theme is working and when it is fading. You must know when to rotate out if the data weakens. You must not marry the idea. You must not hold a stock forever simply because the original story sounded good. A good investor updates if backlogs stop growing, update if valuation becomes extreme, update if policy support fades, update if revenue disappoints, update if a better opportunity appears, update. The principle is to be committed to the process, not attached to the position. Now, I want to address the word leaked in the title. Often people use words like leaked because it creates urgency. But in many cases, the most important information is not truly secret. It is public. The executive order is public. Backlogs are public. Company filings are public. Stock performance is public. Government funding announcements are public. The data center power problem is widely discussed among institutions. The issue is not secrecy. The issue is attention. The market often hides opportunities in plain sight because most people are focused on the more glamorous part of the story. That is an important distinction. You do not need illegal information to invest well. You need to know where to look before the crowd looks there. That is why following public data can be enough. Most investors are overwhelmed by noise. They see endless headlines, political arguments, oil prices, war rumors, AI hype, recession fears, inflation data, rate decisions, and stock predictions. They cannot separate signal from noise. A framework solves that. The framework says, find the undeniable demand, find the bottleneck, find the companies paid to remove the bottleneck, confirm with contracts and backlogs, manage risk. That is much clearer than chasing every headline. Now, let us bring the story back to the big picture. AI is forcing an energy reckoning. For years, investors treated digital businesses as if they were weightless: software, cloud platforms, algorithms, models. Everything seemed intangible. But the AI cycle is reminding everyone that the digital world has physical foundations. Chips require fabs, fabs require power and water, data centers require land power, cooling, and components models require compute. Compute requires electricity. Electricity requires generation, transmission, distribution, and materials. The intangible economy depends on tangible infrastructure. When the tangible infrastructure becomes constrained, the value shifts toward the companies that can expand it. That is the structural insight. This is not only a short-term trade, it could be a multi-year investment theme because grid infrastructure is slow. Data center demand is growing. AI adoption is still early. Electrification continues. Domestic manufacturing policy supports power demand. Aging assets must be replaced. Security concerns require resilience. But multi-year themes are not straight lines. There will be pullbacks, there will be overbought conditions. There will be earnings disappointments, there will be policy noise, there will be rotations, there will be moments when investors declare the theme over. The question is whether the underlying demand continues. If it does, pullbacks may become opportunities. If it does not, the theme must be abandoned. This is why data matters more than conviction. Conviction without data becomes stubbornness. Data without a framework becomes noise. The investor needs both. Now, what would make this theme weaker if AI data center demand slows materially? If power usage becomes far more efficient faster than expected? If government policy reverses? If interest rates rise enough to slow infrastructure spending? If valuations become too high relative to earnings? If supply ramps faster than demand? If major contracts are delayed or canceled? If companies fail to convert backlog into profitable revenue? These are the risks. You should write them down before investing. Because once you own a position, your mind will try to defend it. Defined risk points protect you from emotional attachment. Now, what would strengthen the theme? More long-term power purchase agreements, more data center off, grid announcements, more utility capex increases, rising backlogs for grid builders, margin expansion in component suppliers, government funding moving from announcement to contract, transmission line approvals, nuclear deals with credible counterparties, uranium supply tightness, domestic materials preference, relative strength versus the market. Those are the signals. An investor should keep score, not emotionally, mechanically. Now, let us consider the 5 broad areas again, in simplified form. Off-grid generation benefits when data centers cannot wait for the grid. Nuclear and uranium benefit when baseload carbon-free power becomes strategic. Grid builders benefit when transmission, substations, and reliability upgrades receive funding. Component suppliers benefit when every project needs power modules, switchgear, cooling circuit boards, and control systems. Raw material producers benefit when physical infrastructure demand increases together. These form the AI power chain, not the AI chip chain. The AI power chain, that is a useful mental model. Most people know the chip chain. NVIDIA, foundries, memory, networking, servers. Fewer people map the power chain: generation, transmission, distribution, cooling, components, materials, contractors. As the chip trade becomes crowded, the power chain may be where more attention flows. Again, this does not mean buying blindly. It means the map is valuable. Now, I want to make the final lesson very practical. When you see a big policy announcement, do not ask only what does this mean politically. Ask where will the money go, who receives the contracts, who has existing capacity, who has the backlog, who has pricing power, who supplies the bottleneck, who benefits from both private and public spending, who has already shown relative strength, who is still reasonably valued, who is too speculative, who is already overowned. Those questions turn a political headline into an investment framework. That is what serious investors do. They translate policy into cash flows. They translate demand into orders. They translate orders into backlogs. They translate backlogs into revenue visibility. They translate revenue visibility into earnings power. They translate earnings power into valuation. They translate valuation into risk reward. That is the chain. If any link is weak, the investment may be weak. If the chain is strong, the opportunity may be real. Now, there is one thing you should not do. Do not simply memorize a dozen ticker symbols and buy them because they were mentioned in a story. That is not investing. That is outsourcing your judgment without understanding the system. The purpose of this kind of analysis is to teach the system. If you understand the system, you can evaluate Quanta differently from Bloom, Bloom differently from Oklo, Oklo differently from Camco, Camco differently from Vertiv, Vertiv differently from an aluminum producer, and an aluminum producer differently from a speculative small cap. They are all connected to the theme, but the risk is different. A serious investor respects difference. Now, I will leave you with the simplest version. AI has created a power problem. The grid is old. Data centers cannot wait. The government is responding. Private capital is responding. Contracts are flowing. Backlogs are rising. Certain sectors have already moved. The opportunity may not be over, but the easy part may not be equally available everywhere. So you must follow the money, not the excitement. The excitement is in AI. The money may be in power. The excitement is in chips. The bottleneck may be electricity. The excitement is in software. The contracts may be in infrastructure. The excitement is in the model. The cash flow may be in the grid. That is the inversion most investors miss. And in markets, the best opportunities often appear where the crowd is looking at the wrong layer of the system. The AI boom is not just changing technology. It is forcing a rebuild of the physical systems that make technology possible. If you understand that early enough, and if you manage risk carefully, you can think much more clearly than the person simply chasing the most obvious headline. The goal is not to be excited. The goal is to be positioned where the cause and effect chain sends the money. Follow the money, study the backlog, respect the bottleneck. Manage the risk. That is the principle.